is revealing the secrets that dealers don't want you to know.
These 6 secrets are the reason dealerships fear educated buyers more than anything else. Every handshake, every smiling sales pitch hides something darker. What looks like paperwork is actually profit traps.
The whole structure of the dealership was such that it was almost like a paramilitary organization.
And what feels like winning, like paying cash or making a big down payment, often makes you the perfect victim. So why do they dread cash buyers? How can financing at your credit union cut off their biggest scam? And what happens when you cancel weeks later? The cash buyer trap. Walking into a dealership and announcing, "I am paying cash," feels like a triumphant declaration. It communicates independence, preparedness, and freedom from the burden of monthly payments. Yet to the finance manager sitting across the desk, those words trigger immediate disappointment. What feels like empowerment to you feels like a financial roadblock to them. The reason is simple. Dealerships rely heavily on financing as a major profit engine, and cash derails their most reliable system. The secret begins with the concept known as the reserve, also called the yield spread. When a bank or lending institution approves a buyer, they assign a buy rate, the true interest rate the consumer qualifies for. Suppose the buy rate is 5%. The dealership has the ability to present a higher figure, perhaps 7%, to the customer. That 2% difference between the buy rate and the sell rate does not belong to the bank. It flows directly into the dealer's pocket as hidden profit. If you borrow $20,000, the difference in interest could add up to hundreds or even thousands of dollars. But when you pay cash, that spread collapses. The finance manager loses one of the most lucrative avenues of income in a single instant. Beyond the spread, cash disrupts the presentation of add-on products. Finance managers typically pitch extended service contracts, tire and wheel protection, appearance packages, and guaranteed asset protection in terms of monthly payments. $10 here, $20 there. These small increments sound harmless when stretched across 60 or 72 months, but in a cash deal, the numbers cannot be disguised. A service contract costing $3,000 is presented as $3,000 in full, not hidden inside a monthly payment. Confronted with large lump sums, cash buyers are far less likely to accept overpriced extras. Dealers know this, and they feel the loss immediately. Some dealerships attempt to fight back by offering 0% financing promotions. At first glance, this sounds like free money, but it serves a deeper purpose. By pushing you into financing, they restore the chance to pitch add-ons inside a payment structure. Even if you plan to pay the loan off early, the dealership wins by reopening the door to incremental upselling. From their perspective, financing always offers more room to maneuver than an outright cash deal. There is also a psychological tactic at play. Finance managers sometimes set product prices so that the total ends in smooth, rounded figures. $3,000, $500, or $4,000 even. Rounded sums feel easier on the brain, making it less painful to write a check. Odd totals, like $3,973.26, feel awkward and discourage purchases. This subtle manipulation reveals how carefully the dealership works to soften resistance, even when you bring cash. How should you respond as a savvy buyer? The answer is clarity. Always ask the finance manager to write down the actual price of every product, not just the payment increase. Insist on transparency and never let them convince you that financing is necessary for the sake of convenience. By paying cash, you maintain full visibility of what you are spending, which empowers you to negotiate fairly and decline unnecessary products. Ironically, while dealerships dislike cash buyers in the moment, they often benefit from them in the long run. Cash deals reduce the risk of missed payments, defaults, or lender disputes. The frustration stems not from the buyer's decision, but from the loss of immediate profit opportunities. Ultimately, "I am paying cash" is more than a statement of method. It is a declaration of control. It strips away illusions, cuts off hidden profits, and places the buyer firmly in command. For dealerships, it is a dreaded phrase. For you, it is one of the strongest shields you can carry. Now, if denying them interest income seems powerful, the next dirty secret reveals how even your down payment can become a battlefield. The big down payment myth. For generations, the wisdom has been repeated like scripture. The larger your down payment, the smarter your deal. Parents pass down the advice, financial experts echo it, and countless articles celebrate the strategy. After all, putting down more money upfront seems logical. It reduces the total borrowed, lowers the monthly payment, and should cut interest costs over time. From a consumer's perspective, those benefits are very real. But when viewed through the lens of a dealership's finance office, a large down payment is not a cause for celebration. It is a source of frustration because it shrinks their profit potential in ways most buyers never notice. Dealers profit from the interest rate spread. A bank may approve you at 5%, but the dealer could present 6 or 7%. Pocketing the difference. The larger the loan, the greater their profit. A big down payment lowers the financed amount, reducing the dealership's spread and income. Flat fees from lenders create another complication. Sometimes manufacturers offer promotional rates such as 2.9% that cannot be marked up. In these cases, lenders compensate the dealership with a flat payment for processing the loan. But even flat fees often scale with the size of the financed amount. A buyer who finances $40,000 may earn the dealership a $300 flat, while a buyer who finances $10,000 may only generate $100. Multiply this difference across hundreds of sales, and the dealership loses tens of thousands in annual revenue when customers insist on large down payments. There is also a psychological angle. Buyers who put down a large sum tend to be more cautious with extras. They already feel the weight of a significant cash investment, so they scrutinize each product more closely. A $3,000 extended service contract looks far less appealing after you have written a $15,000 check for a down payment. By contrast, a buyer rolling everything into financing is easier to persuade. An extra $15 a month for 72 months sounds harmless, even though it adds more than $1,000 in total. The dealership thrives on this payment mentality, and a large down payment disrupts it completely. Minimum financing thresholds add yet another layer. Many banks require a minimum loan amount, $5,750 or even $10,000. If your down payment pushes the financed amount below those limits, the dealership may not be able to secure financing at all. No financing means no reserve profit, no flat fee, and fewer opportunities to bundle products into payments. What feels like a financially responsible move to you can feel like a collapsed sale to them. Still, the truth is that a large down payment does benefit the buyer. It reduces interest, lowers the risk of being upside down, and provides peace of mind. The myth is not that large down payments help you. They certainly do. The myth is believing that dealerships support your choice. In reality, they prefer you borrow more, not less. When you hear a finance manager suggest, you might want to keep some of that cash for emergencies, or with interest rates so low, it makes sense to finance the full amount. Remember the hidden motivation. They are not guiding your finances. They are protecting their income streams. So, while a big down payment is a smart move for you, it is a quiet frustration for them. And if shrinking their profits in the finance office feels satisfying, just wait. The next dirty secret reveals how arriving with your own loan approval can shield you even more powerfully. If this breakdown is opening your eyes, imagine what's still ahead. Don't just watch, arm yourself. Hit subscribe right now so you never miss the tools that protect your wallet. The Credit Union Shield. Walking into a dealership with a loan already secured from a credit union is like carrying a protective shield into battle. Most buyers enter the finance office unprepared, relying entirely on the dealer to arrange funding. But when you sit down with a pre-approval in hand, you immediately change the balance of power. The dealership knows that your shield makes their usual tactics far more difficult to use, and they dislike it intensely. Dealer-arranged financing hides profit in the interest rate spread. A lender may approve you at 5%, but the dealer might present 7%, pocketing the 2% difference. That margin can mean thousands in profit. Arriving with a credit union approval at 5% removes their ability to inflate. Credit unions are especially dangerous for dealerships because their structure is designed to serve members rather than maximize profit. They often provide lower interest rates, fewer hidden fees, and more flexible terms than traditional banks. A buyer armed with a credit union approval is harder to manipulate because the terms are already transparent. The finance manager knows you are not a blank slate. You are informed, cautious, and less likely to accept inflated offers. Dealerships, however, will not simply surrender. They often attempt to win back control by saying, "We can match or even beat your credit union's rate." At first, this seems like a benefit, but their goal is not to save you money. Their goal is to keep the financing under their roof, where they can still adjust terms, tack on fees, or wrap extras into your payments. Even if they match the rate, the fine print may include clauses or costs that tilt the deal back in their favor. The psychology here is just as important as the math. By announcing that you already have financing, you reveal confidence. You demonstrate that you monitor your credit, you shopped for terms, and you refuse to hand over control. This immediately changes how the finance manager views you. Instead of a passive buyer, you become a negotiator who must be handled carefully. That shift strips away their comfort zone. There is also a protective layer many buyers overlook. When you use outside financing, add-on products like extended warranties, tire coverage, or guaranteed asset protection cannot be disguised as tiny monthly increases. With a credit union loan, these items stand alone at full price. Without the camouflage of payment-based selling, it becomes easier to say no. That transparency is another reason dealerships dislike your shield. However, not every pre-approval is equal. Some customers only have a pre-qualification, which is simply an estimate, not a guarantee. A full approval is specific and enforceable, and that is the shield you want to carry. Finance managers know the difference and will exploit vagueness if they can. The advantages continue even after the sale. Credit unions typically allow early principal payments, easy refinancing, and friendlier customer service. These benefits further weaken the dealership's grip, since they count on restrictive contracts to keep you locked in. So, should you let a dealer attempt to match your rate? Possibly, but only with caution. If you entertain the offer, demand everything in writing. Ask for the exact buy rate from the lender. If they claim there are no prepayment penalties, point to the contract and ask them to highlight where that promise is written. Your shield only works if you refuse to set it down. The myth that dealer financing is simpler or safer is exactly that, a myth. Convenience is their camouflage. Your credit union approval exposes the truth, leaving them frustrated and vulnerable. And if stripping away their financial weapon seems powerful, wait until you see what happens when you challenge the very speed of their process. Because the next dirty secret reveals how time itself becomes a tool in their hands, and how reclaiming it can save you thousands. The pressure clock. Inside the finance office, one of the most subtle weapons dealerships use is not the paperwork, the calculator, or the contract. It is the ticking of time. Managers understand that urgency can be far more powerful than logic. The faster they make you decide, the less chance you have to analyze or compare. This tactic is often called the pressure clock, and it silently governs the pace of the entire experience. Think about the environment you face as a buyer. You have already spent hours negotiating a vehicle, test driving, and waiting for the sales process to unfold. By the time you reach the finance desk, fatigue has set in. You want the deal completed and the keys in your hand. The dealership knows this and exploits it. They deliberately stretch the day so that when you finally sit across from the finance manager, you are drained. In that state, urgency is your enemy and their greatest ally. The pressure clock is clearest when extras are pitched. Service contracts, tire coverage, or guaranteed asset protection are framed as urgent. Buy today or lose the deal. In truth, most can be purchased later, often cheaper. Dealers rush you, knowing delay reduces profit and increases chances you will comparison shop. Even the way numbers are shown supports the tactic. Instead of quoting the full cost of a $3,000 warranty, they break it down into $15 a month over 72 months. The math is the same, but the psychology is not. A small monthly figure feels insignificant when presented quickly. Without time to step back, you may agree to thousands in add-ons disguised as pocket change. The tactic extends to loan approvals as well. Finance managers may warn, "This rate is only guaranteed today," or "Interest rates are climbing, so you need to lock this in immediately." While some approvals eventually expire, most remain valid for several days or even weeks. The sense of vanishing opportunity is manufactured pressure carefully designed to silence hesitation. Breaking free from the pressure clock requires awareness and preparation. First, Remember that nothing forces you to accept products on the spot. Extended warranties and similar add-ons can almost always be purchased later. Second, use the power of pause. If you say, "I want time to compare prices," you reclaim control. It signals that you are not bound by their timeline, and it places the burden back on them. Another effective defense is bringing a second set of ears. A partner or trusted friend disrupts the rhythm of urgency. With another person present, the manager must navigate more questions and more scrutiny, which slows down the pitch. If you cannot bring someone physically, place a friend on speakerphone. Dealers dislike this, but it weakens their control over the pace. Remember that hesitation is not weakness. Every moment you slow the process, you gain clarity. Fatigue and rushing are their weapons, but patience is your shield. A deal that seems urgent in the moment will still be available tomorrow. Cars do not vanish overnight, and products rarely disappear. The only thing at risk when you delay is the dealership's profit margin. The pressure clock is designed to steal your calm. Recognizing it turns the tactic on its head. Time should be your ally, not your enemy. Each pause is an act of resistance. Each question a reminder that you will not be rushed. And if disrupting their urgency feels empowering, the next dirty secret goes even further. Imagine unraveling their profits weeks after the deal is signed. That power comes from cancellations, and it is the next weapon dealerships fear the most. Time is their weapon, but knowledge is yours. If you've made it this far, you're already steps ahead of most buyers walking into a dealership blind. Make sure you lock in that advantage. Like this video, subscribe and ring the bell. Stay with us, because the next secrets will completely change how you fight back. The cancellation game? Few things unsettle a finance manager more than a customer returning after the sale and saying, "I want to cancel." Those 4 words do more than reverse a decision. They strip away profit, undo performance metrics, and reveal to the buyer that power does not end when they drive off the lot. The cancellation game is one of the most guarded dealership secrets, and once you understand it, you will see why managers dread it so deeply. When buying a car, you are shown extras like service contracts, tire coverage, or guaranteed asset protection. Many accept them, hidden inside monthly payments. Only later, reviewing paperwork at home, do buyers notice thousands quietly added, sometimes $4,000 or more. That realization often triggers the choice to cancel. Here is where the hidden mechanism of the chargeback enters. Dealers earn commission when products are sold, but that commission is not permanent. If the buyer cancels within the first 60 or 90 days, the profit is pulled back by the lender or provider. This reversal is known as a chargeback, and it strikes directly at the finance manager's income. Imagine celebrating a deal one month and losing the commission the next. That is why cancellations sting more than almost anything else in the business. Some dealerships attempt to stall. A customer might hear, "The paperwork takes time," or "We will process this next week." Delays are intentional. By dragging out the process, they hope the buyer will miss the cancellation window or give up. The only way to counter this is persistence. Requests must be submitted in writing, dated, and followed with consistent calls. Documentation becomes your greatest ally when facing a dealership that hopes you will grow tired of the chase. Understanding how cancellations affect your loan is equally important. If you financed a product with the vehicle, the refund is not given as cash. It is applied directly to the principal balance of your loan. Your monthly payment remains the same, but the overall amount you owe drops. This saves interest over time and helps you pay the loan off faster. Dealers sometimes downplay this fact, suggesting that a cancellation has little effect. But the truth is that it can shorten your financial burden significantly. The variation in product pricing makes cancellations even more powerful. A warranty sold for $4,000 at one dealership may cost $2,500 at another. Guaranteed asset protection might be offered for $1,000 in one finance office and half that price elsewhere. By canceling, you free yourself to shop for better rates and avoid being locked into inflated costs. For finance managers, the damage is not just financial. Their performance is measured by product penetration. How many add-ons are attached to each loan? High cancellation rates weaken those numbers and may harm their reputation with upper management. This is why cancellations are resisted so fiercely. They attack both the wallet and the scoreboard. For consumers, the path is clear. Act quickly, Keep records and know your rights. Every product contract includes a cancellation clause, and reading it closely ensures you are not misled. Submit requests promptly and confirm that the refund is applied to your loan. Persistence is the key to regaining control. Cancellations prove that the dealership's power does not end when the sale is complete. You still hold leverage, and using it wisely can save thousands of dollars. And if undoing their profits after the fact feels satisfying, the final secret is the most important of all. It is the very core of how dealerships make money. Hidden within the numbers themselves, the interest rate spread. The interest rate spread. At the center of every finance office lies the secret that fuels dealership profits more than any other tactic. It is not the extended service contract, nor the tire and wheel coverage, nor even the overpriced paint protection. The deepest and most carefully hidden source of money is the interest rate spread. This mechanism is simple in design, yet massive in impact, and most buyers never realize they are paying into it. When a dealership submits your loan application, the lender responds with a buy rate, the true interest you qualify for. Suppose it is 5%. The dealer can raise it, perhaps quoting 7%. That 2% difference is not from the bank, but pure profit for the dealership. This hidden gap is called the interest rate spread. At first glance, 2% might seem minor, but stretch it across $25,000 financed for 72 months, and the additional interest can reach into the thousands. Multiply that by dozens of transactions each month, and the dealership earns tens of thousands of dollars annually from this single tactic. It is the crown jewel of their finance playbook, precisely because it is invisible to the average customer. What makes the spread so powerful is that it hides in plain sight. Optional products at least have listed prices, but the spread is buried in loan paperwork. Most buyers assume the rate offered is the rate dictated by the bank, when in truth, the bank has no idea what figure the dealership presented. The lender only sees the buy rate. Everything above that is dealership profit. This is why dealers dislike outside financing. A credit union pre-approval locks in the rate at the source, eliminating their ability to inflate it. Without control of the loan, they cannot pad the interest rate, and their most profitable tactic collapses. That is also why they try to lure buyers back with lines such as, "We can match or beat your credit union." Their goal is not to compete for your benefit. It is to regain control of the loan so they can adjust terms and reintroduce the spread. The interest rate spread also explains why dealerships discourage large down payments. The larger the amount financed, the greater the profit margin they can extract. A $10,000 loan at a marked up rate provides far less income than a $30,000 loan. This is why you will sometimes hear, "With interest rates this low, you might as well finance more." Such advice is not for your financial health, it is for theirs. What can you do to protect yourself? The strongest defense is awareness. Ask directly, "What is the lender's buy rate on my approval?" Most finance managers will hesitate because the question exposes their tactic. Another step is shopping independently for financing before you enter the dealership. Arrive with a secured approval, and you strip away their ability to manipulate numbers. Some states have placed limits on how much a dealer can increase rates, but even capped markups still add significant profit. Regulation alone is not enough. Vigilance, preparation, and patience remain the buyer's greatest weapons. The interest rate spread represents more than money. It represents the imbalance of knowledge. As long as one side stays in the dark, the other side profits. But when you shine light on the spread, you dismantle the foundation of their system. For dealerships, no secret is more valuable. For buyers, no knowledge is more powerful. You've just uncovered 6 dirty secrets dealerships never wanted you to know. Now the choice is yours. Walk in blind or walk in prepared. If this gave you power, imagine what's still ahead. Smash that like button, subscribe, and turn on notifications, because the next video won't just save you money, it could save your future.